Good evening, everyone. Today we'll be doing our SHRM CIA 2. The topic that we have chosen is merger and acquisition. Our team consists of AMITHA, MADHU, Maryam, Tayyiba, myself PRAGNA, SANJUNA, and SHRUTHI. AMITHA will be explaining about the mergers and acquisition. Over to you, AMITHA.
So I'll give a quick introduction about mergers and acquisition. Mergers and acquisition are defined as consolidation of companies. Basically, mergers and acquisition are increasingly becoming a strategic choice of organizational growth and achievement of business goals, including profit, empire building, market dominance, and long-term survival. So the basic ultimate goal of this is, however, maximization of shareholder goal. Coming to the definition, merger is a combining of two business entities under common ownership. Likewise, acquisition is a corporate action in which a company buys most, if not all, of the target company's ownership stakes in order to assume control of the target firm. To make it more clear, coming to the meaning of mergers and acquisition, that's in the next slide. The term mergers and acquisition are often used interchangeably, but the meanings are different. So mergers is a combination of two companies to form one new company. So the combination of these two companies involves a transfer of ownership. So both companies surrender their stock and issue new stock as a new company. Likewise, in acquisition, it's where one company purchases another, and it's also called takeover. So it can be done either by acquiring the ownership over 51% of the shareholder capital or by taking over the assets of the company. So basically, it involves the acquiring company, that is the acquirer, making an offer of the common stock of the other company, that is acquiree, at a fixed price per stock. Over to Shruthi.
Thank you, Amita. I will be explaining about how mergers and acquisition is used in an organization. So there are four types of merger and acquisition. First is horizontal merger. This kind of merger exists between two companies that compete in the same industry segment. Second, vertical merger. A vertical merger is a kind in which two or more companies in the same industry but different fields combine in business. Co-generic merger. It is a kind in which two or more companies association are some way or the other related to the production processes, business markets, or basic required technologies. Fourth is a conglomerate merger. It is a kind of venture in which two or more companies belonging to different industrial sectors combine their operations. Next slide. So let's take a look at merger and acquisition process. First, the first step in the merger and acquisition process is creating a good acquisition strategy. This requires the acquiring company to have a clear idea of what goals they want to achieve from the acquisition. Second, merger and acquisition search criteria. The next step is to identify key criteria for target companies in line with the acquiring firm's acquisition goals. Target screening. The acquiring firm then begins target screening by assessing the potential targets in line with the acquisition criteria. Fourth is acquisition planning. The acquirer will then meet the target companies and offer a good value for them or their assets. Valuation analysis. After the initial conversation, the acquiring firm will ask the target to provide substantial information, including current financials, operations, liabilities, and more. Negotiation. After gathering enough information from the evaluation of the target, the initial offer will be rolled out. Due diligence. This process begins as soon as the offer has has been accepted by the buyout company. Purchase and sale contracts. In this stage, a final contract for sale is set up, where both the companies make a decision on the type of purchase agreement, asset purchase, or share purchase. Financing strategy for acquisition. While the acquiring firm has already considered its financials in the early stages of the deal, the fine detail of the financials are put in place only after the purchase and sale agreement has been signed. Last point is closing and integration. The acquisition deal is closed and representatives of both the firms work together on the merger. Over to Maryam.
So I will be talking about the examples of merger companies. So the okay, so I will be talking about the example of merger companies. The first one is Idea and Vodafone. So it is reported that the Vodafone Idea merger is to be valued at 23 billion. Although the deal resulted in a telecom giant, it is safe to say that the two companies were pushed to do so due to the entry of Reliance Jio and the price war that followed. And the both companies struggled with the growing competition in the telecom industry. The deal worked for both the Idea and Vodafone, as Vodafone went on to hold a 45.1% stake in the combined entity with the Aditya Birla Group, which was holding a 26% stake, and the remaining by Idea. So on 7th September, Vodafone and Idea unveiled its brand new identity, which is VI, that marked the competition of the integration of the two companies. The next one is Tata and Tata Steel and Chorus. So the Tata's takeover of Chorus in 2006 was valued at over $10 billion. The initial offers from Tata were it was at 4.55 billion per share, but following a bidding war with CSN, Tata raised its bid to 6.08 per share. And following this, the Chorus has had its name changed to Chorus Steel, and the combination resulted in the fifth largest steel making company. So next examples will be explained by Pragna.
Thank you, Mariam. So I'll be taking up and giving the examples regarding the acquisition that happened. So the first example that I've given is Uber Eats and Zomato. As we all know, that Zomato is one of the highest giant of food delivery that is present in India. So in recent times, we also have experience, and we are also part of where we also saw that Zomato was acquired by Uber Eats, which is regarding the Indian operations. So the food delivery business that Uber was running, the deal was almost closed around 350 million. So Zomato is was given a 10% share to acquire the Uber. And after the acquisition, the combined entity of Zomato and Uber Eats was expected to be around 50 and 55% in the terms of orders, pulling ahead of Swiggy. So as we all know, the Swiggy is one of the top competitor in the food delivery system. And it was also expected that most of the Zomato users will be transited to Uber Eats. So next slide, Mariam. Okay. So I'm sure all of us are aware about this acquisition that happened, that Facebook was acquired both Instagram and WhatsApp. So this happened around 2012, where Instagram was acquired for around 1 billion. So it was the largest acquisition that happened at that time. So while Instagram wasn't big at at the point of 2012 and 13, so but now once we see the market that Instagram has created, it is one of the biggest a business acquisition that as Silicon Valley has seen so far. So when talking about the Facebook, it was a merger. It was an acquisition that happened to have a hold on a greater market. Instagram and WhatsApp. So we have around 30 million users and around the world, and even more every day. It's been increasing, and today it has given a boost to Instagram and a lot of active users, which is almost crossing around 500 million of platform every day, and it is worth around more than 10 billion of Facebook, generating a lot of revenue. The recent update is around regarding 2018 was 9 to 10 billion. And not just only Facebook and Uber Eats, there are also examples of Disney where it was acquired in 21st century for like 71.3 billion. So these are certain trend setters in the market while talking about the acquisition. And also Microsoft, which acquired LinkedIn for 160 $60 per share. It is almost around 26 billion deal that was brought against the competitor Salesforce.com. So Microsoft was acquired LinkedIn, which was a greater platform and one of the greatest deal. Thank you. Next will be taken up by Sanjuna.
Thank you, Pragna. So after understanding what mergers and acquisitions are on a foundational level, it is necessary for us to highlight the key differences, because to an onlooker, it almost seems the same. Since both the processes end up in resulting in one giant company, it is easy for someone to mistake merger and acquisition to be the same. However, there are nuances, and we'll look into it through certain bases. So there are four key differences. First one being that when it comes to merger, it is two business parties that are joining together to form one new business entity. Whereas when it comes to acquisition, it's usually a giant company taking over a target company. When it comes to mutual decision, merger is agreed upon by both the parties that are involved in the deal. Whereas when it comes to acquisition, the deal is usually a mutual one, but there are cases where it's not a mutual decision, and such cases are also called hostile takeovers. Thirdly, when it comes to comparative stature. So when it comes to mergers, the size, scale, and the status of both the companies are almost on equal terms. But when it comes to acquisition, that's not the case. The giant company that's usually acquiring the target company has a larger, financially stronger background than the target company. And when it comes to power and shares, so it is understandably easy to see that merger, the dilution of power happens when two companies come together because there is an equal status, and the merged company now has to issue new shares. Whereas when it comes to acquisition, the company that acquires the target company has absolute power, and new shares are not required to be issued because it's a complete takeover. So the next slide. So after understanding all this, the basic question that comes to mind is, why would any company or an organization choose to go for merger and acquisitions? So mergers and acquisitions usually happen for these reasons. First of all, it's for potential growth opportunity that's there. So in order to increase their share in the market or to increase their finances, companies usually go for mergers and acquisitions. Secondly, if there is an acquisition and the giant company wants to take over the target company, it's in order to remove the threat that is there by the new entrant that is there in the market. So thirdly, it is to increase power when it comes to supply chain. Once you have acquired a larger share in the market, it is easier to have a larger power when it comes to supply chain and distribution. But now that we look at it from the target company's point of view, why would a target company want to go for acquisition, right? So there are very drastic cases where most of the target companies who have made a deal to be acquired by a giant company is when their business is unprofitable and they have a threat of closure and bankruptcy to their own business. So they usually opt for selling it. Secondly, when it comes to the target company being acquired, it is done because they want to avoid any kind of competition with the giants. It is not easy for them to financially have like a larger portfolio, or invest millions when it comes to research and development as well. So in order to avoid these kind of competitions, they usually opt for acquisition. And thirdly, it's because of trading of cash cows. So what does this mean? So there are companies that usually opt for constructing and establishing a new company that's like either a unicorn or it's unique in some form or fashion, and that is taken as a cash cow. So wherever there is an offer for it to be acquired, they usually go for the sale. So in this concept of mergers and acquisitions, we can understand that it is a very complex process. So there are pitfalls of its own. Firstly, when it comes to these kind of processes, the structural issue that pertains to these processes are very complex in nature. It's a very long duration of time when this transition and integration actually happens. So structural issues usually are concerned with the organizational restructuring. Secondly, when it comes to technological issues, patent rights, transfer of technology, such things happen, and there might be issues relating to that. Financial restructuring refers to when two companies are coming together, their policies may not be the same when it comes to remuneration, benefits, etc. And that is where financial restructuring is required as well. And fourthly, most importantly, streamlining of workforce and retention of talent is key, because when two companies come together, the workforce size usually upscales and it is very large. So in order to avoid any kind of duplication and redundancy when it comes to work, people usually opt for streamlining of workforce and retention of main key talents. And the next slide. So for conclusion, we can conclude saying that merger and acquisition, even though sometimes they are used in a singular phrase, they have their various subtle differences across the board when it comes to their process and dealership as well. And secondly, mergers and acquisitions are very complex processes. It takes long duration of time and a lot of effort when it comes to the transition process as well as the implementation. Even after the deal is struck, there are various stages that needs to occur to complete the merger and acquisition. And thirdly, we can understand that HR function plays a very significant role in this transition and implementation process. So in this function, what usually happens is training and coaching, along with a lot of restructuring, is done in order for the employees that are transitioning from one company to another. They have to get acclimatized to the new company. And so with that, we would like to conclude. Thank you.